Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about ACHR.
That's right. We're looking at ACHR Aviation, Inc., which is, well, arguably the primary contender in this whole urban air mobility sector. A very speculative space.
It is, and they're accelerating toward this critical commercialization window, which we all see coming between 2026 and 2028. But the real story right now, the thing we need to unpack, is this pretty sharp divergence between their operational milestones and the actual equity price action.
Exactly. The stock is just stuck. It's in this tight consolidation phase after getting knocked down, about 40% from its 52-week highs?
And it's consolidating right where you'd expect technical resistance to kick in. The short-term momentum is, let's be honest, it's broken.
It is. But I think you'd agree the real puzzle and sort of the frame for our whole discussion today is what's happening underneath the surface, the market microstructure.
Absolutely. We've consistently seen that nearly half of the daily trading volume, it hit a peak of 45.80% on December 10, 2025, is being transacted quietly, away from the open market in these so-called dark pools.
Right. So the central question we have to tackle is, does this high level of off-exchange activity signal, a methodical institutional accumulation ahead of some catalyst? Or do the huge, undeniable fundamental risks, the execution, the cash burn, do they just override these subtle technical signals?
Well, I'll put my cards on the table. My thesis is that the microstructure data really does confirm a quiet, persistent institutional accumulation. It's designed to build a foundation for what could be a violent upside breakout. Look at it. The consistently high percentage of off-exchange volume, always above 40%, it strongly suggests large, sophisticated players are buying up block positions. And they're doing it strategically to minimize any upward price impact. This defensive buying is, in effect, building a structural floor under the stock, especially around that critical volume shelf we've identified near the $8.18 level.
See, that assumes the flow is purely accumulation, and I think that's debatable. Institutions use dark pools for distribution, for hedging, just as often.
Sure, but when you couple that consistent hidden demand with the company's balance sheet, the bullish case gets a lot harder to ignore. ACHR is incredibly well capitalized right now. They're reporting approximately $1.64 billion in cash and equivalents as of Q3 2025. That gives them a liquidity runway of about 14 quarters. So that cash mitigates any immediate solvency fears, and it lets them focus entirely on type certification.
Okay, the cash position is strong. I'll grant you that.
And then you look at the derivatives market, and the sentiment there is just screaming bullishness. The put-to-call ratio is remarkably low at 0.13. That represents highly aggressive bets on the upside. And it doesn't stop there. Look at the immense open interest at that pivotal $10 call strike for January 2026. That OI, it acts as a structural gamma magnet. As the price gets close to $10, the dealers who sold those calls, they have to hedge their exposure by buying the underlying stock. It creates this positive feedback loop that structurally pulls the price toward and often past $10. It's setting up for an early year move.
That's a compelling argument based on the market mechanics. I get it. The gamma magnet is powerful, but I would frame it very differently. That level of aggressive positioning, well, it often comes right before a major disappointment, especially in these pre-revenue, highly speculative names when the underlying technicals are weak. I'm sorry, I just don't buy that the technical structure supports accumulation right now. The stock is technically bearish. It has definitively crossed below both its 50-day moving average, which is around $9.85, and its 200-day at $10.02.
So the death cross.
Exactly, the death cross. For our listeners, the 50-day is your short-term sentiment. The 200-day is the long-term trend. When the short-term trend falls below the long-term, that signal confirms momentum has just decisively stalled after that 40% drop. It's a signal of structural weakness, plain and simple.
Momentum has stalled. Yes, I agree. But I'd argue that the institutions are capitalizing on that very moment of weakness and indecision to quietly build their positions without chasing the price up.
Perhaps. But the whole investment thesis is shifting. It's moving from pure speculation to a much harder assessment of execution risk. And my core concern really is in the unit economics of this whole venture. Skeptics, backed by some pretty detailed analysis, argue that for Archer to hit a viable 10% net income margin, which is basically the hurdle for aerospace manufacturing, they need to produce and sell over 1,100 aircraft per year.
And their target is what?
Well, to put that into context, their own stated optimistic 2030 target is only 650 aircraft. So the math just doesn't compute under the current cost assumptions. It suggests the long-term viability is, well, it's questionable unless they can radically change their supply chain or pricing.
But that's a problem for 2030. The immediate problem is the next 3 years. And you admitted yourself the 14-quarter runway addresses solvency concerns. Why should investors today worry about the difference between 650 and 1,100 aircraft 6 years from now?
I'm not convinced by that, because the long-term economics problem becomes an immediate solvency problem because of the cost of time. Certification delays, they're absolutely standard in aerospace. They never hit their first targets. And they're catastrophically expensive here. Every single quarter of delay burns somewhere between $100 and $115 million in EBITDA. That cost just rapidly chews through that $1.64 billion cash reserve you mentioned, and it fuels the whole vaporware narrative. Investors aren't paying for 2030 potential. They are paying for the probability of a 2026 certification. And that probability costs $100 million every 3 months it's missed.
Okay, let's address the microstructure again, because it provides the best counter-argument to this fear of delay. You said the dark pool volume could be distribution, but I'd argue the sheer volume of shares shorted creates a powerful bullish mechanism. We have 91.27 million shares sold short. That's over 15% of the tradable float.
And the days to cover is remarkably low, sitting between 1.9 and 2.4 days, which suggests those shorts could be closed out pretty easily.
Exactly. But the days to cover becomes irrelevant if a sudden positive catalyst like final FAA certification or a huge new airline order hits the market. 91 million shares, all trying to find liquidity at the same time, will absolutely overwhelm the daily volume. It'll force prices up and fast. It's a massive coiled spring, and the accumulation in dark pools is the institutional prep for that trigger.
That suggests this volatility isn't all just about accumulation. I mean, it ignores the massive spike in fails to deliver, FTDs, we saw on November 10th, 2025. That day, 14,753,410 shares failed to settle.
Right.
Now, for listeners, an FTD is when one party to a trade fails to deliver the shares on time. That is an extraordinarily high number for Archer. It suggests the underlying market mechanics are under severe stress. This usually reflects fundamental pressure or concerns that, people are trading shares they don't actually possess. When you combine that with the high short interest, it points to a disorderly environment, not quiet housekeeping. And the implied volatility range for January 2026, plus or minus $1.47 or 17%, it shows the market is expecting risk in both directions. It confirms the extreme binary nature of the stock, not just the upside.
That's a very interesting point on the FTD spike. It certainly validates some of the volatility. But let's shift focus to what really differentiates Archer from its peers, like Joby, and what justifies that dark pool accumulation. The huge Stellantis manufacturing partnership. This is either a massive competitive moat or a huge dependency.
For me, it is absolutely a core dependency and a source of financial fragility. The reliance on Stellantis, which committed up to $370 million in labor costs in exchange for Archer equity, that introduces critical counterparty risk. We know Stellantis has faced recent headwinds. They had a big earnings miss in Q3 2025, a strategic pivot on their part, say they exit the UAM space to focus on their core EV production. That would leave Archer with a major hole in their OpEx budget and, potentially, a half-finished factory in Georgia. Plus, this whole arrangement institutionalizes dilution. They're paying for labor not with cash, which they have, but with stock.
That's a compelling risk assessment. Though I'd frame the partnership as a critical, capital-light manufacturing moat. It fundamentally changes Archer's risk profile. This partnership significantly reduces Archer's immediate cash burn, allowing the company to dedicate its entire $1.64 billion cash reserve solely to R&D and securing type certification. It lets them scale up without the massive upfront construction costs that sink so many startups in this industry.
Okay, fair point on the cap ads.
And the structural benefits are even more profound. We just saw the mandatory conversion of the Class B supervoting shares into Class A shares. That move removes a crucial governance barrier to future index inclusion. When this company hits certain metrics, the tailwind from passive funds tracking the S&P 500 would drive hundreds of millions, if not billions, in mandated institutional inflows. The Stellantis deal, the share restructuring, these are signs of long-term strategic positioning.
That's all forward-looking. The market today is focused on execution risk, which brings us to valuation.
I think the current price reflects the significant, maybe even irrational, discount compared to Joby Aviation. Joby's market cap is sitting between $12 and $14 billion. ACHR is at about $5.6 billion. If ACHR achieves FAA certification within 6 to 12 months of Joby, which many analysts think is likely, that valuation gap should compress dramatically. This is exactly why you see analysts like Cantor Fitzgerald with an overweight rating and a $13 target. The market's waiting to pay for execution. The microstructure suggests the smart money is positioning now.
See, I disagree that the market is irrational. I believe it's rationally pricing in the high execution risk. And that pessimism is evidenced by JP Morgan's recent downgrade to neutral with an $8 target. They are demanding proof. It's the show me phase. The delay factor is the key problem. And beyond that, the overall sentiment is incredibly fragile, especially among retail investors. We saw that mass with the misinformation about a non-existent reverse split stemming from the totally unrelated ACHR Limited, ARCH. That just highlights how easily retail sentiment can be misled and become disconnected from the company's true financial story.
So, to summarize my position, I maintain that ACHR's structural balance sheet strength, backed by that $1.64 billion in cash, and the strategic advantages from the Stellantis partnership offer a powerful foundation. The consistent microstructure evidence, that persistent high volume of dark pool accumulation, it strongly points toward controlled institutional positioning that is setting this stock up for a violent upside breakout on FAA certification news. The immense short interest is just a fuel for that move.
And I will reiterate that while the liquidity is sufficient for now, it's being consumed rapidly by these enormous development costs. The fundamental challenges of the unit economics, the bearish death cross pattern, and the significant counterparty risks all suggest that this institutional flow might just be hedging of existing positions, like convertible notes, rather than pure accumulation. Until that FAA hurdle is cleared, the stock price remains, in my view, fundamentally detached from its true long-term intrinsic value.
So we both agree then that ACHR is a highly polarized, completely binary asset. The final outcome will be decided entirely by execution and regulatory navigation over the next few quarters.
Absolutely. And the tell for investors has to be that dark pool data. If we see continued high volume accumulation at these prices, that signals institutional confidence. But a breakdown below that $8.18 volume shelf, coupled with a drop in off-exchange volume, that would signal institutional abandonment and confirm the market is shifting its focus back to pure execution risk.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.